Hi everyone, welcome to Trader Chats, unique perspectives from seasoned traders. I'm your host, Imran Lakha, founder of Options Insight and 20-year professional options trader. As you might know, I became a trading mentor about 3 years ago, but I thought these conversations would be a great way for my students to gain valuable perspectives from some of the professional traders that I know and respect. I hope you enjoy the episode. Welcome to Trader Chats, everyone. In today's episode, I've got Tony Greer from TGMacro, and the name of the episode is Respect the Tape. Tony, thank you so much for making the time to be here. How are you doing?
I'm doing great, Imran. Thanks for having me on. I really appreciate that.
No, it's great. It's great. I mean, I thought I'd been trading a long time, given that I've been in the game for 20 years, but you've been doing it a lot longer than me. So I'm sure myself and the viewers can learn a lot from you. And that's why I brought you on.
Right on.
So before we start, for like the one or two people who don't know who you are, why don't you give us the TLDR on your career and kind of, what you've been doing in trading for all these years?
Yeah, sure, Imran. I'll try to give you the quick and dirty on my career. I got out of college looking for a job on a trading desk, and I was determined to get one. I got started in FX at Sumitomo Bank. I moved from there to UBS, where I spent about 2 years working for UBS in FX and commodities, spent 6 months in Zurich. And that's where I met the people at J. Aron, which was the commodity trading arm of Goldman Sachs. They wound up luring me very easily over to their shop, where I spent about 6 years trading commodities and, really learning everything I know about the rigors of being a serious speculator and trader and investor. I was there for, through the Goldman Sachs IPO, and got a great life lesson because I left Goldman Sachs after that to trade the tech stocks that I had been investing in for about 5 or 6 years, because I had this vision that the NASDAQ was going to go up forever and I was going to be able to retire on investing on these technology stocks. So when I left Goldman Sachs to trade the NASDAQ in March of 2000, literally with the NASDAQ at its peak of 5K and the commodity markets about to go into a 10-year super cycle, I had to figure out how I was going to sort of, make myself known in the markets from a different angle. So I became I became an equity sales trader by digging into my Rolodex and figuring out that I had a lot of contacts in the equity market. And I really started educating them on what was going on in the natural resources space and kind of giving them a lesson on how commodities trade and how to anticipate what was going to happen in some of the stocks that they were trading, and built out a really, really good book of business. But the main underlying driver of how I was acquiring clients and doing business was through the distribution of a market note that I was writing every morning, just to basically to give those equity clients an idea of what was going on in the commodity world and in the macro world. So obviously that morphed into the Morning Navigator, which is the newsletter I launched in 2016, right before Election Day, with a big bet that Trump was going to win that election and the world was going to change dramatically. So since then, I've been navigating markets fairly successfully, knock on wood, for a really large set of clients that span from every type of market participant, which I'm extremely proud of, from a day trader to family offices to portfolio managers that manage multi-billion-dollar, sums of money at large, plain vanilla institutions. And so I have a really wide client base that spans the globe, quite honestly. And I spend my time, staying in touch with those clients and publishing my newsletter 4 days a week about what I see going on in the markets and trying to guide investors to sort of shape their portfolios the right way, which I feel now more than ever is probably, the most important thing that you can do for the money that you have invested. So we can leap off any point from there, Imran, but I think that covers us kind of up to the present in my 5th year of writing the Morning Navigator.
Yeah, I mean, I basically seen you from Real Vision, right? And the thing that really struck me about you, seeing you, nearly every week on Real Vision Daily Briefing, was just how straightforward you are about the market, and you've been banging the drum about commodities for a long time, and obviously that's your speciality, that area. But I was also of the view that having some real assets in your portfolio was going to be very, very important, right? Around sort of 12 to 18 months ago. And having you there drumming that point home every week really gave me more confidence to have a very large allocation in commodities relative to what maybe the average portfolio allocation would be. And I want to thank you for that, really. It's helped me, and I'm sure you've helped a load of other people. But one of the other things you say quite a lot is about price action and respecting the tape, right? And kind of letting markets confirm your thesis before really going after a position, right? And I think that's something that I've learned through my experiences as well. And I just want to kind of pick your brains on, how you think about that and any core principles you have, or how do you kind of stop yourself from getting chopped up? Because sometimes if you're a price action junkie, you can be chart chasing a little bit, right? You can be like, okay, it's going up now, so I'm going to buy it, but then it just sells off in your face. Like, how do you manage that? Because I agree with respecting the tape and respecting price action, but then how do you then balance that with not getting chopped around by volatility, basically?
Great question, Imran. It's a question that I face a lot of time, very often, when I get new subscribers and they see the positions that I've been in for a while that are profitable, and their gut reaction is to write back and say, hey, is this a good time to get into these, these names that you've been in? And my answer is 99.9% of the time, no, this is not a good time, right? And that always leads me at least to get the customer to sort of take a breath and say, oh, okay, okay, I got it. I don't have to rush right into this now, something that's been rallying for 9 months and is 25% away from its 200-day moving average. That's not even something that I'm going to pile into, right? So, Imran, everything comes down to really identifying first the performance that pulls you into the name, right? I have a system where I'm monitoring a number of securities and how much they move on a daily, weekly, monthly, quarterly, and annual basis, right? And that's the sort of lens that I do my stock screening or security screening through. And that's what allows me to first identify the things that are trending, right? They'll start to show the same performance across days, weeks, months, and quarters. And when you look at that, you say, okay, this is something that's going from the bottom left to the top right of my screen. I got to figure out where it makes sense for me to get in and where it makes sense for me to trade out. So I'm a big technical analyst, and I employ moving averages and trend lines, really nuts and bolts of technical analysis to, guide myself and clients into the right time to buy things. And for example, we, for a really good recent example, just to cite one, is in the last week or so, we've seen energy stocks just ripping to new highs, almost every day, where we had just seen a big pullback in the metal space. So for me and my clients and my book and my newsletter, I was, guiding my clients, this is a big pullback in metals. The trend is higher. This is a pullback that we should participate in because I like the risk reward here. And that's really what it's all about, Imran, is lining up that risk reward, right? When you look at the chart and something like XLE is 20% of its moving average, it doesn't look like you have as good a risk reward on a long trade from there as you did if you say looked at the XME chart, metals and mining, which had just pulled back into 200-day moving average, very long-term support level. And I guided my clients into that ETF and some of the underlying names, which have also bounced. But the bottom line is that was the right point for risk reward, and not 2 months ago when XME was sailing away above its 200-day moving average, right? Like, that's not the way that I like to enter. So, everything is there's a lot of patience involved with the way that I trade.
That's the word I was about to say. Yeah, I was like, my takeaway from what you've just said is zooming out and having some patience, basically, right? Not being in a rush to get into these positions, right? Just be like, zoom out, figure out what you structurally like and what you want from what those different duration performances are telling you, and say, this is what I want my book to look like, but I don't need to have that book tomorrow, right? I will let the market come to me, and I'll get in at opportune moments when the market gives me those, basically.
Exactly. So it's kind of, as you now see, that's how I employ sort of a radar screen and a view matrix. So my radar screen is the sort of trades and views that I've developed, but haven't put on my book yet, but sort of the ones that my process of following the markets and looking at charts have led me to. Right. A lot of times, I'll be bearish something like software, for example, and it will be the inverted story of XLE, where you'll be bearish something and it's just riding so far below moving averages, getting so damaged that you can't jump in at that price. No, right. Exactly. You have to wait for the latecomers to get burnt to see a kind of retracement in the move. And then you got to wait for it to get to a good level where your moving average is really good, where you can sort of look for a 4-to-1 return on your trade,
And how do you think about sizing then? Like, I'm one of those people who likes to average into positions. So I will very rarely trade my full size in one clip, right? So because I don't believe I'm going to be that amazing at my timing every time. So I'm going to be like, give myself 2 or 3 bullets to build into a position. And you know what, if it goes right immediately, at least I make some money. But if it doesn't go right immediately, I have the chance to average in at a better level. And, I've predetermined the amount of exposure that I'm willing to build into. So how do you think about that?
Yeah, you do have to employ, what I call partial executions. When you talk about sizing a trade, I immediately conjure the trade size increments that I think about in my trading account for starters, right? And that's very specific for me. I try to have specific buckets of sizes of risk that I like to put on, where, for example, one of my positions will never be more than 10% of my account. This way, if I'm risking 10% on that trade, then I won't lose more than 1% of my capital, right? And if I have that kind of baseline mechanism for every trade, I know where I'm in there. So now to speak to your point about trade entry and averaging, that's something that I also employ, where I will take one of those trade allocation piles of capital and say, okay, I'm going to divide this by 3 and get into this trade. Yeah. And pick 3 spots to get in. And to be quite honest with you, 75% of the time I'm sort of adding to strength. You know what I mean? If that's fair, I'm trying not to average down. So
so your second clip is often worse entry than your first clip.
No, the opposite. Oh yeah, that's fair to say. A worse entry. That's right. That's right. Yeah. Exactly. A worse entry, because I'm still generally, everything here is an art, not a science. So for me, there's no rule that applies to every single situation, right? And in that it is a little bit of an art, not a science. You can say, okay, well, I'm going to be an adult here and I may need to average down, right? I want to buy natural gas stocks on this dip, right? I don't know where the bottom is going to be, so I may have to average down. That is something that I will do very, very carefully, like 10 times more carefully if I spot something that has been trending higher and finally broke down into moving averages and is consolidating, because then I get the opportunity. That's when I'm salivating, quite honestly, Imran, because I can believe that the trend will continue. I can believe in my own ability to time when it is going to come out of consolidation and back into trend mode. And then also, a lot of times that you'll get a security that dips below all the moving averages. What I like to do, if I'm playing that security still from a bull market position and a bull trending position, is just use the moving averages for my points of entry. And if you can picture it, a lot of times you'll see a chart recover the 50-day, and then the 200-day, and then the 100-day, and then the 50-day. And then it's above all the moving averages and has a real shot technically to test its recent high. So I really like that type of trade where I can buy the recovery of the 200-day and add on the recovery of the 100-day and put my final piece on the recovery of the 50-day moving average. And while they are 3 consecutively worse prices, I have a lot more confidence that I'm going with the markets.
Market's confirming, the market's confirming that you're doing the right thing, basically.
Bingo, exactly. So that is right there.
Yeah.
That is the birth of where the most successful trades that I've ever had on, where it starts. And then the procedure from there is to bump your stop up along the way.
Trail stop, yeah.
Trailing stop, right? Exactly. So you look.
But I have to say, my experience of trailing stops is that you often trail your stop, and you're doing it because you're trying to be sensible and prudent about risk management. But then you get stopped out of a winning trade a lot when you do that as well. It's like, had you just respected your original stop, made peace with the idea that that's what you could lose, you just stay with the winner forever, basically, right? And that's really what you want to do when you're trading. You want to run those winners, and I think that trailing stop actually reduces your probability of running a winner quite often, in my experience.
Right? Yeah, the stops, the trailing stops are tough at the beginning of a trade, right? When you're only 10 or 15% right so far, for example.
Yeah.
You've got that trailing stop. You're not really confident that you've got this trade nailed because you've only got a bit of a skin in it, right? You've only got a bit of a profit in it. You're like, it's not really paying me the way I'd really like it to, right? This is not going perfectly. For me right now, for example, in the oil trade where I've been long USO for 2.5 years and I'm 225% in the money, now I can put my stop in a lockbox below the market. Right.
Yeah.
Where I'm fine giving back profits when I've got that much in it. I would rather just be able to sleep at night saying, you know what, oil's 120. I don't think about getting out until like 85 offered. So I have like a lot of room now. I have room where I can scale out on a rally and buy back on a dip and keep the same size position, but keep improving my average. So that's the way I like to look at those kind of things.
Right. And do you volatility adjust your position sizing as well? So you kind of, if it's nat gas, it's going to be much smaller positions than it is if it's like, I don't know, copper or something, right?
If it's nat gas, I generally put on a 2-2 and then begin trading. You know what I mean? A pair of ballerina shoes. And I tiptoe very softly. Exactly.
I haven't traded nat gas in a long time. It's just too high octane for me right now.
It is, and people don't realize that. It's unbelievable, Imran. I have clients that write back to me after I write a bullish note in natural gas, and they're like, "Hey, should I buy some of these producers right now?" And you're like, "Good God!" Like, once again, no, do not buy anything right now. Let's talk about this and plot this out first. That's always the response.
So, okay, let's move on to a slightly different topic. So obviously we've both been doing this a long time. And, a lot of traders I speak to have certain things that stick in their minds, right? Like war stories or memories from the market that just, you're never going to forget. It's like a special situation that either went as you thought or was completely unexpected, or, what are your war stories, or what are your, and then on the back of that question, are there any big blunders that you've made in trading that just stick with you and you just will never make again because it was quite traumatic and, you really remember it clearly?
Imran, you set that question up so well that I can come up with one story that covers both.
Oh, nice.
Both a good war story and something that taught me the sort of most basic tenets of my trading postulates today, which kind of start with don't get caught short physical commodities, right? So the setup of a war story is I was quoting the gold book while my partner at J. Aaron with David Todd was quoting the silver book. And we were going into Easter weekend, and this is Thursday before Good Friday. And to try to set the story up, he was trading silver. I'm trading gold. Gold is like a $300 item. Silver is probably a $4 item, in the high fours, 475 or something like that.
Mm-hmm.
So to cut to the chase, we've got an option expiration weekend over Easter weekend, right? Mm-hmm. And going into the, everything is sort of fairly normal. The market's definitely, firming up towards 480, mid 480s. And as the session is starting to die out, all of a sudden silver trades from 480 to 490 to 495. And going into the close, we've got clients calling us up and everybody is buying silver. And we're like, holy shit. So we get caught short silver on the bell at $5, right?
Right.
Right away, a client calls up after the bell and says, hey, can you, through the sales desk says, hey, can you quote this client just silver and 500,000 ounces, right? And we just said, look, this thing just rallied 30 cents into the close. We have a position. We'll quote you a price, but it's not going to be a good price. And they were like, fine, I just need some liquidity. So we quoted them a price of 510, bid at 540.
Oh, wow.
Right.
You were bid through the level where it closed. Wow. Okay.
Because we got lifted at $5.
Yeah.
This person sold back to us at 510 and we took a 10-cent loss on Thursday before Good Friday.
Yeah. You'd be happy to just, happy to stay.
We would have taken that and been, whoo, thank God. So the salesperson goes, at 540, you sell 500,000 ounces of silver. So I look at my partner and we both
that's like, another 8% higher than the close. Jesus.
Bingo. Right. And so now we don't know where it is. And we hear that Phillips Brothers is going to exercise their 550 calls over the weekend.
So oh my God, they're going to take delivery at 550.
Bingo.
Jesus.
So now, now you're in a total scramble. Luckily what happened. Yeah, exactly. Well, so here, the point is, to cut to the war story part of the once Dave and I sort of settled up what our position was, which was short 500,000 ounces. Again, by the time we went home, we were able to buy some off of our book. Like we had, producers selling up to $5 and we were able to call up all those producers and say, you're filled, you're filled, you're filled, you're filled.
Oh, they left some orders with you basically.
Standing orders to sell silver up towards $5. So we just scooped that silver in against what we lost to cut our short down.
Yeah.
Imran, you're talking about losing $3, $4, $5 million on this trade if this goes wrong. Right in your book. So, once Dave and I got sorted out, we're short 500,000 ounces. We're going home. We're going to attack this thing in Tocom, on Friday night, on Good Friday, and then attack it again Sunday, and we'll cut our position down. But the first thing we did was go to the bar across the street and do a shot of Jack Daniels because we were hoping to keep our jobs, number one, and be able to trade out of it. So to make a long story short, we find some sellers in our customer book, everything kind of levels out and we escape with our lives. But what did happen was Fibro did exercise the 550 calls. They woke up a whole bunch of sellers and we managed to piece the whole position together and trade out of it. We got short again. And to make a long story short, from a completely hairy situation, traded out of it, but learned that you've got to take this commodity, your liquidity, the timing of a quote, the nature of the position that you're getting stuck with, the whole scenario, everything has to be taken into account.
You just can't underestimate how much these things can move, right, in a short space of time. Right?
I mean, we had counterparts in the market that didn't have the selling on their books that we had, quoted the same clients after the close and lost silver and got brutalized because they were short from 475 up to 550.
Yeah, no, it was funny. It's funny you say this about, judging liquidity and things like that, because one of my biggest things that I remember was 2010, the European sovereign debt crisis, right? So that really kicked off in April, May that year. And the first 3 months of that year was so quiet and volatility was so depressed and liquidity was abundant. And I was running a desk over at Merrill's at the time, right? And we were just being encouraged to take on more and more size from clients. Like liquidity's there, you got to gain market share. You've got to put up these big clients in these ridiculous size clips because it's fine. Nothing's going on. So we were encouraged to do that. And it's like, okay, fine, I'll do it. Felt a little bit uncomfortable, but all right, I'll do it. And we were making some money. And then literally in the blink of an eye, the sovereign debt, Greece has a problem. And in the blink of an eye, all that liquidity that you thought you had disappears. And you're stuck with these beastly positions that you are not getting out of, basically, right? And then the market squeezes you. And let's just say the summer of that year was not a fun experience. Yeah, but it taught me a lot of lessons. Yeah,
those are the type of, those are the scenarios that real blowups are made of, right?
Yeah.
Imran, like the ones where you hear about desks losing millions and millions of dollars at a clip and shutting the desk down, firing a trader, whatever it is. I mean,
illiquid risk. It's all about illiquid risk, right?
Illiquid risk and traders getting caught off guard, underestimating that, right? People will quote prices to clients without even checking the liquidity in the market first, right? Which was an insane thing to start. And now when everything is electronically traded, and there's no word of mouth trading anymore, no interbank market, nobody that you can go to that you've got a relationship with that'll say,
do you a favor.
I'll help you out here. Look, I'm long some silver. I'll sell you some of this here, I'll sell you down 10 cents to help you out. That stuff went on in the gentleman's market, and that market is closed today. So
it's true. That's true.
Every man.
That was great. That was a great story, man. I like that.
Never forget.
All right, another piece of wisdom I'm after from you, right? So, what are your thoughts around? Obviously you've been trading for ages. You're clearly a commodities expert, but do you believe in sticking to a certain asset class and becoming a specialist in that, or do you think there's value in sticking to a certain style of trading, but broadening your horizons across assets because sometimes there's not a lot going on in certain assets, right? Sometimes it can be like, trust me, equities. I used to trade the FTSE for crying out loud. It would realize 5 vol and do nothing for 6 months. If I didn't go across the pond and start trading other indices, I would be bored out of my brain. I'd make no money. So what has been your experience of that, and how do you view that?
Yeah, that's another good question, Imran. I used to have a book myself that would have natural resources stocks, tech stocks. I'd have a small ophthalmic company in there. I'd have a biotech company. I'd be long a European miner. And I would realize that there was no way to try to actually make money trading, right? That was just pure finger in the wind. I think I know where the market's going bullshit, right? And what I do now is dial into a sector that has a story to it, right? With something going on, i.e. energy, right? For the last 2 years, something serious going on. Dig into that story, dig into those trends for several months in a row, become an energy specialist and trade nothing else but. Figure out if this is worth sinking all of your time into, to the point that you can get really good at trading, a small number of these names over a short period of time, to the point that you're comfortable taking risk. And that's how I've always, I should say that not always. That's how, since my methods of trading have been market driven, that's where I found the most success, if that's fair. And that's sort of saying, cut out the ophthalmic company. That's taking a flyer. Forget about the European metals and miner, because now you've got currency risk. Forget about the biotech idea that your buddy told you about, because that thing's been sitting here for 6 months and might sit here for another 6 months. And employ your tactical skills to what's going on, and only to what's going on. Like I've been so focused, Imran, in the last year that I probably haven't traded any stock or any ETF outside of those that are within the oil and gas or metals and mining industry.
Interesting.
If that's fair to say. And it's just because, when the story came to life, that, the commodity market was finally going to react to the Fed doubling its balance sheet and the ECB doubling its balance sheet. And we were finally going to get that, transfer from technology driven paper, liquidity driven markets to hard asset driven, non-technology driven markets. Once you realize that pivot was coming, that's something that you can really dig in and hang your hat in. It seems to me like that trade is developing with a very, long time horizon on it, because things feel very different this time.
I mean, there's no doubt that trade's worked, and there's no doubt there's been a lot of value in being, digging into that space to see where the alpha is, right? But what about the argument of diversification? Like, what about the argument that you're a commodities bull, and whilst energy looks like the fastest horse in that race, why not have a little bit of ags and a little bit of metals and stuff like that, but just to diversify in case something happens in the natural gas market that makes it dump 30% next week, right? Is there what would you say to that?
Same trade.
Same trade. You can buy, the natural gas and the crude oil trade is just the tip of the spear, right? The natural gas price is the tip of the spear for everything ag, right? Because they rely so much on agreed on the fertilizer thing. Yeah.
Fertilizer story right through. So that's the tip of that spear. So really all you're doing is not diversifying.
I see. Right? Okay. So what you're saying is, if you really understand the drivers in what's driving the whole commodity space, it's all on energy, basically, right?
It's just saying, Imran, let's say we're long physical energy, physical natural gas, physical oil. Say we get long the producers on that, right? We buy a bit of XOP, we buy some Southwestern Energy, some this and that. And then we decide that we're going to get into the ags too, because they're going up with grain markets. And we buy some grains and we buy the ags. Then just say natural gas goes down $1. Everything goes down $1. You know what I mean? Like that, the whole trade across the board gets slaughtered. So
no, I get your point. I mean, I guess
opportunistically, I'm fine with it. Other charts time differently than the energy trade. Sometimes there might be an ag trade that is a late bloomer and consolidated.
Well, yeah, I'm trying my best to counter what you're saying to see if I can find anything there, right? So what if the energy trade's already played out, but you think the ags trade, which is dependent on the energy trade, is lagging? Do you then, rather than adding ags and keeping your energy, do you switch from energy to ags because that's where the juice still is, basically?
I do. Right. I do, because I'm still a trader, Imran. And if I've had the energy and I bought the energy into support and upside, or just had a reasonable position on, now I've got energy that is 25% away from its moving averages. That's the first place I'm going to go to raise cash.
Yeah.
Right. Yeah. To say, and I just did this and illustrated it really, really, really clearly and loudly in the Navigator as I was doing it, essentially for a family office client of mine. I recommended we sold 25% of our XOP position that we've been riding for over a year, just so that we could buy some of this dip in metals and mining stuff.
Yeah. It makes sense. Yeah.
So things like that, where you say, okay, this money looks like it's a better risk of going higher than the money that just ran. So yeah, I'm rotating in and out of favorability all the time.
Fair enough. So you're rotating to where you see the alpha, but arguably the macro driver is the same across all of them. So therefore you don't just own all of them, because it's just kind of increasing your exposure to the same thing, the same dynamic. Right. Okay, that makes a load of sense. Yeah, and I appreciate that. That's really good. And that really helps. I think people will really, appreciate hearing that, to see how you think about things. And then another sort of question, a little bit different, is what's more important to you? And I'm assuming, I kind of have a guess of what you're going to say, but I'm going to say it anyway. So what's more important to you? Do you think it's fundamentals, or is it positioning, right? When you're thinking about a trade, like what matters more, fundamentals or positioning to you?
Man, to me as a trader, the positioning issue is always the last issue, right? Okay. So if I have negotiated my way or navigated my way into a trade smartly, it means that at some level I've been patient. I've waited for a pullback. I've waited for that trade to look less favorable than it has on its highs, right? So I'm trying to think of which way I can go with this.
You're almost saying through your entry point selection, you've almost already taken advantage of positioning, basically.
Yeah.
Right?
So it's the kind of thing where the positioning issue is something that arises late in the trade. For example, we knew fundamentally that oil, for example, wasn't going to be priced in negative dollar terms, right, for a very long time, right? That was the fundamental lead to that story. That was the first trip in there. Then once you're in the oil trade, the only thing, once the market is starting to get, sentiment is going from 0 where everyone's bearish to 100 where everyone's bullish. And now as sentiment proceeds through 75, 80, 90 towards the most bullish it can be, that's when you get positioning starting to become a factor, because now everybody knows about the trade. It's about to be on the front page of the newspaper and everybody's got it on in some capacity, right? So that's sort of managing the positioning is usually the last part of a successful trade, right? So for example, managing the positioning in oil has been, fairly easy because the spec length has not gotten enormous in any way, right? So for me, there's been no rush to get out of the oil trade because I don't sense that there's a lot of length that could topple it over, right? Rather, right now, the oil market to me feels like the risk is that this thing goes up $10 in 2 sessions, right? Because we're just
I agree. I mean, I was looking at the volatility complex within oil yesterday, and I was like,
how it's skewed.
I was surprised to see the skews for the put side, not for the call side, right? And the only way I can explain that is people who own oil are buying risk reversals against it. They're buying puts and selling calls to protect themselves. So there's a bid to the skew. But I was surprised because obviously when it all kicked off in Russia, you had a massive call skew because everyone didn't know where the top would be. But, over recent months, it's massively flipped the other way, and I agree with you. I think the risk is higher. I don't think the risk is of a massive collapse right now. So,
we're going to be leaning on, we've already verbally and visibly started pivoting toward the Saudis to pump more. And as we've known since like the Bank America call from Thanksgiving 2021 was that Saudis don't have spare capacity.
No, exactly.
So that's sort of, I've had that in the back of my mind for 7 months now. That has allowed me to stay in the trade, and they still don't have spare capacity and the market's not long.
I mean, look, again, we're calling this respect the tape, right? Last week, they tried to raise production quotas. Market said bothered, and rallied. I mean, that if you respect the tape, that tells you the market knows they've got no spare capacity, right?
The ultimate respect the tape when you're, a bull market trader, you're long a security. What is more confirmation that you're right than a dip that is steep in price and short in duration?
Exactly.
Right. So when a bull market dips super steep and comes roaring back, you're like, fucking A, it's on. I mean, there's buyers everywhere, right? That's all it tells you is that there's buyers at every price. So
I hope we're not a massive counter indicator now, Tony, and we're going to call the top in energy right now.
It's okay, Imran. I've called 15 tops in energy in the last 2 years by talking about it, so I have no problem with it. As long as the P&L is going the right way, it's all right.
Yeah, exactly. Well, you just lightened up anyway, right? So you don't mind a dip. No, all right, that's cool. Okay, so slightly different topic of conversation then. So obviously, you've been doing it a long time. You've been a trader, you've been a salesman. So what kind of made you start the Morning Navigator? What were your motivations there? How long do you think you're going to keep doing it? Is it something that, is there something else driving that passion and that desire to do that newsletter? Like, tell me more about that, because it's similar to me, right? I'm doing similar things to you. So I just like to know what drives you there.
Yeah, I guess the driver behind the Navigator is the desire to sort of, offer a sort of point of mentoring for people that don't really understand how to take risk or know where to look to figure out where they should be taking risk. I understand that for the novice trader and novice investor, that can be really intimidating, right? It's like trying to pick a bottle of wine off of the Sparks menu. There's 6,000 bottles. They're from all 7 continents. And where do I start? You know what I mean? Like, and I feel like markets can be that way towards people. Mm-hmm. So, it's always been first of all, I write so that I know what I think about markets, if that's fair to say.
100%. That helps so much. Figure out, get your thoughts in one place, right? And figure out what you think is really helpful. Yeah, I agree.
Force yourself to organize them, force them to make sense, kick the tires until, it all lines up and you can see what you're driving at. Yeah, that's super important. So I'm trying to think of how else I can speak to that.
But it's one of those things, so you think you're just going to keep doing this until, is this like your retirement trade basically, right? There's no,
I've discovered that I'm through surviving the markets for 30 years, right, and never bailing out. I've decided that I'm a survivor in this market, and my next iteration of being a survivor is, to sort of take the knowledge that I've learned and share it with people, see if I can help other people invest. I've become an entrepreneur, but I feel like I'm kind of learning that I've always been one, because I had to be one to survive the markets from 1990 through 2022, and always have a relatively strong position in them in terms of, it's at least making a living. So I think that, it's very much the retirement trade in some level, because now I can sort of build a business alongside trading my account and managing, my own trading account. And that's something that I'm getting really, really addicted to.
It's quite rewarding, isn't it? When not only are you managing your own money and using your skill set, but you're helping other people do the same thing, right?
Exactly. And, there's so much to it. The markets are so big that they allow for that, right? It's like taking a bachelor party to Las Vegas. There's room for everyone, right? And as much as we've got, our followers on the Navigator and in my Slack channel, none of that is too big that it's going to be, a market moving thing, right? So we can just sit here, observe markets. Markets are generally deep enough for us to trade in the sectors that we want and, navigate the sectors we want. So if I can continue trading my account aggressively, smartly investing for my future, and help others do both at the same time, then that's a happy life for me.
Yeah, no, I totally agree. And on the whole trading side of things, I've always thought of the reason I love trading is I see it as the puzzle that you can never fully solve, right? So it's just always interesting, always intellectually stimulating. You're constantly, the market schools you on a regular basis, right? Tries to inflict as much pain as it can on as many investors as it can. So definitely keeps life interesting. What keeps you doing it? What keeps you trading and what keeps you excited about trading after doing it for so long?
That's it right there. And it's kind of along the lines of, I have like sort of friends and family that look at me in awe, and they're like, how do you, write about markets? Like, how do you come in and write something about markets every day?
Yeah.
And I'm more of the mental mindset where I turn on the screens and number one, I don't know which thing to write about first.
Because it just speaks to you, right? The market.
Two, you've got to shut me up about what's going on. You know what I mean? I turn on my screen and write 10,000 words about markets right now. So and they're always changing. So that's the thing. It's that puzzle that every day you get a new bit of information, and that contributes to the picture of the trade. And you've got to make your decisions. And it's kind of like that competitive thing, like being in a sports match and playing hockey or lacrosse. It's all last minute, reactionary, competitive, and it's self-survival type of skills start to build in there. And I think that once you develop those and that's the most liberating thing, Imran, about trading, is that learning how to trade is the biggest piece of freedom you can ever afford yourself.
It's true. That's why so many people want to learn how to trade, right? It's true.
There it is right there. You can figure out how to trade. You don't have to report to anybody for the rest of your life. So there's a lot to be said for that. And it's not easy.
That's the game plan.
That's the game plan. Yeah. And it's not easy, but it can be done. So
Tony, I'm gonna leave it there because you've been very generous with your time already. And I know we're approaching the hour, but thank you so much for showing up on Trader Chats. It was a pleasure meeting you. And I'm sure the audience, will really appreciate all the wisdom you've been, giving out in this episode. It's fantastic.
Imran, I love your energy, man. I really appreciate the way you went about this so tactfully, and I think you really pulled out some actual knowledge in for your clients and your listeners, which is really about the best thing you can offer people.
Before you go, tell people where they can find you, Navigator on Twitter, etc.
Yeah. You can find my website is TGMacro.com. Very simply, there's a big, there's some samples of my work, some a write-up about my background there if anybody needs it. You can find me on Twitter at TGMacro. Feel free to DM me if you're listening to this podcast and say you're a friend of Imran's or a listener and you have a question. I'd be happy to help you. And if anyone wants to email me, it's Tony@TGMacro.com. Happy to help people.
Brilliant. Cheers, Tony. And I'm definitely going to be bringing you back. So
I look forward to it, Imran. Hopefully we made some good calls here. We'll see what happens.
Take care, buddy. Cheers.
Be good. Peace.
Bye. Thanks for joining us today. I hope you enjoyed the episode. To learn more about Options Insight and our trading community, please visit us at www.options-insight.com, or you can subscribe to our YouTube channel and also follow us on Twitter at options_insight. Until next time, thanks.